Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Navigate the Tax Cut and Jobs Act for Food and Beverage. Before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls of the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have two presenters with us today from Moss Adams. We have Shad Winters, partner, and Annah Bingham, senior manager. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Shad to get the presentation started.
All right, thanks, Amy. Appreciate that. My name is Shad Winters, as mentioned. I wanted to wish everybody a happy Halloween. We are going to go over the Tax Cuts and Jobs Act and some of the changes that are going to happen and some of the sunsets of certain tax provisions. Just kind of how we got here and the background of it. The Senate did pass a budget resolution for fiscal year 2018, and that opened the door for the Senate Finance Committee to work on a tax reform. The Tax Cuts and Jobs Act was signed into law on January 1, 2018. This was a substantial tax law change. I really haven't heard of a tax law change of this magnitude since maybe 1986 is kind of what comes to mind. But with the tax cuts, we had some tax hikes to help pay for the Tax Cuts and Jobs Act. And when that sort of thing happens, we go over budget, and then we have to have some tax hikes to help pay for it. That brings a level of complexity to the tax law. Built into the law to help pay for it was also the sunset of certain provisions on December 31st, 2025. This means on January 1, 2026, tax law reverts to the tax law before the Tax Cuts and Jobs Act passage. Because the sunset is part of law, it would actually take an act of Congress to prevent the sunset of these tax law changes. So let me move forward here. And then future uncertainty. We know there will be changes with tax provisions expiring. We also know there's an election coming up. Each candidate has their own policies that they're running on. We will be monitoring the election next week to help us have conversations about potential changes to the tax law. We don't think anything will happen right away, but there is potential for change. It would probably be later in 2025 is what we would expect. It is better to be proactive rather than reactive. Being proactive will help us avoid any surprises and plan for tax ahead of us, whether that be saving in tax today or saving tax overall. And we'll kind of get into some of that in a minute. So corporate versus pass-through entities. We had this qualified business income deduction, also known as Section 199A. That's a 20% qualified business income deduction for pass-through entities, and that expires at the end of 2025. We also at that same time had a decreased corporate rate of 21%, but that is not set to expire. That is permanent unless Congress acts. Let's back up and say, what is a qualified business income deduction? That allowed businesses owners to deduct up to 20% of their qualified business income. The deduction is available to owners of pass-through entities such as sole proprietorships, partnerships, S corporations, and certain trusts and estates. The qualified business income deduction was part of the Congress's effort to reduce taxes for businesses and their owners. Keeping in mind, corporations got the lower rate, so this is what owners and businesses got, from their end. The only difference is the 21% is permanent as of now, and then the QBI deduction, qualified business income deduction, is set to expire at the end of 2025. We will have an example of this on the next slide to show the change in tax from the expiring qualified business income deduction. But I look at it from a percentage standpoint. We went from a 39.6% down to a 37% when the Tax Cuts and Jobs Act was created. And then if we get a 20% deduction on qualified business income, that gets us down to a top rate of 29.6%. And that's what I looked at when we had the owners and businesses that were not corporate. Again, corporations got 21%. Then we had the qualified business income at 29.6% as a top rate. You will see this 10% increase on the next slide when we revert back to the 39.6. So that brings into question choice of entity. Now that we have a 10% change in tax rates for individuals, does that bring back to the table discussions of entity under current law? With other tax law changes like qualified small business stock, does a C corporation become more attractive, moving from an S corp back to a C corp? These are all questions to discuss with your CPA, as each taxpayer has their own unique sets of facts and circumstances. Is your current business structure still most tax efficient option under the post Tax Cuts and Jobs Act tax code? That's what we want to drive to. And the next little box there, accelerating income, does paying more tax in 2025 make sense with tax rates going up in 2026? We could consider accelerating income in 2025 and deferring deductions to 2026. Any fixed asset purchases, capital improvements could wait until 2026 to the lower tax years with higher rates. So, of course, we would have to, look at costs of paying tax earlier. There's the cash flow and present value of cash, given the current interest rates and current borrowing or lost earnings on cash reserves. Where are we with the, our current cash flow? Have we already looked at your accounting methods? We have opportunities with accounting methods. For 2024, to be a small taxpayer, our gross receipts of 30 millions or less. We could look at cash basis of accounting. How do we handle inventory? All these accounting methods can help us move, taxable income around to get the rates we want. Do we want to pay again now, tax now versus tax later? That could be an option. And then I'll let Anna go over the example.
Thanks, Shad. Yeah, so we're going to walk over a high-level example of the qualified business income deduction. So if there's a business owner who has $2 million in qualified business income in 2024 and 2025, the QBI deduction is 20% of that amount, so $400,000, with remaining taxable business income of $1.6 million. The federal income tax rate on that amount in 2024 and 2025 is 37%. And the federal income tax liability would be $592,000. When we go forward to 2026 with the sunset of the QBI no longer being applicable, your taxable business income would be the $2 million, with the federal income tax rate increasing to 39.6%, with a federal income tax liability of $792,000. So the combination of the expiration of the 20% business income deduction and the increase in the top federal income tax rates from 37% to 39.6% causes the business owner's effective tax rate on business income to jump from 29.6 to 39.6 and increases the business owner's tax bill by $200,000 in this example. Like Shad mentioned, it's good to start planning for this and thinking about it and seeing what can be accelerated into 2024, 2025, or what could be pushed out So if we go to the next slide, bonus depreciation and section 179. So bonus depreciation allows an additional first-year depreciation deduction equal to an applicable percentage of the cost basis of qualified property placed in service during the year. Under the Tax Cuts and Jobs Act, used property qualifies for bonus depreciation except for property purchased from a related party. Bonus depreciation is set to expire for property placed in service after 2026. It decreases to 60% in 2024, 40% in 2025, and 20% in 2026. Enhanced Section 179 expensing remains at $1 million, with phase-out starting at $2.5 million adjusted for inflation, and the inflation-adjusted amounts are on the slide for 2024. So if we think about it as the impact of bonus depreciation diminishes, there are opportunities such as a repairs and maintenance analysis, and it's a good time to start thinking about this, and these studies can be done now to help plan for the future. And similar for bonus depreciation, with the tax rate increasing to the 39.6 in 2026, maybe it makes sense to do some type of analysis to see if electing out of bonus in 2024 and 2026 to push those deductions to a higher tax rate year. Those are things that can be done now to start thinking which might be the better option. Pass-through entity tax election and SALT cap. So the $10,000 cap on the state and local tax itemized deductions expires after 2025. When the state and local cap was put into effect under the Tax Cuts and Jobs Act, many states created workarounds to get around this deduction cap by function of pass-through entity tax elections. With the SALT cap sunsetting after 2025, each state has different rules that were put into place when these elections were created. We'd recommend consulting with your current CPA to make sure you have an understanding of these state rules, since every state differentials, and start thinking about a strategy for 2026. I'll let Shad take it.
All right. Excess business loss limitation. This was originally set to expire at the end of 2025. However, the Inflation Reduction Act did extend this through 2028. It is something to be mindful of. Non-corporate taxpayers are subject to this limitation on the amount of business losses used to offset their non-business income. So excess business loss are carried forward. They actually changed their character, which is interesting, for federal income tax purposes to a net operating loss for the following year. So the net operating loss has a different limitation of 80% of taxable income, but doesn't necessarily limit based on business versus non-business income. As you see here, the excess business loss limitation is adjusted for inflation. The 2024 amounts were $305 for a single taxpayer. And we'll go right into an example. So here's an example. In 2024, T, a single taxpayer, has deductions of $555,000 from their business. Now, T's gross income from that same business is $200,000. So you could see how T, this taxpayer, has $355,000 loss. We know from the previous slide that the limitation for excess business loss was $305,000. So we can only offset our non-business income by $305,000. Now I have a carryover of $50,000 that will carry over to future years. Now, interesting enough, that carryover of $50,000 can be used to offset business or non-business, but it does have its own set of limitations under the net operating loss rules, and that limitation is 80%. So this could also be a strategy for us. If we have a transaction coming up in 2026 and we wanted to, I'll say non-business, we could have losses in 2024 and 25 that come in and help mitigate the tax in 2026 under the net operating loss rules, and also maybe even have more deductions in 2026 but we're limited in 26 to only the 305,000. These are all just kind of options for us. Again, with the complexity of all the tax law, it's good to get in front of somebody and kind of plan for these types of items. And this is one of them. All right, moving along. This has nothing to do with Tax Cuts and Jobs Act. I will throw that out there. But California, I thought, well, you know, there is something. California, we have a lot of businesses in California. I don't normally chase California, you know, with federal rates being so much higher. But California has crept up a little bit with their rates, 12.3% being the highest. Plus, we can add on a couple percentage points for the $1 million or more. So you're looking at 14.3%. And you know, we're kind of talking about this in this presentation to have no surprises come April. You know, we don't like those. So I thought, let me just let everybody know on this webcast that, you know, California did pass this Senate bill. If you have over $1 million of net income or adjusted gross income, your net operating losses from 23 will be suspended. You will not be able to offset your income if you're over that dollar threshold at all. So as we're planning and we have net operating losses coming into the current year, those could be suspended depending on your income. And also limitation on credits. If we're thinking we're going to have a credit to be able to offset all of our income, well, it's limited to $5,000 of taxable income. Again, I just threw this slide in there just so that, you know, we don't have any surprises. This isn't necessarily Tax Cuts and Jobs Act, but we know that we have a lot of businesses in California. And from a planning standpoint, cash flow standpoint, we thought it'd be a good idea to throw this slide in there. All right, Anna.
Yes, so we'll go through some expiring fringe benefits. So in 2024 and 2025 for food and beverage expenses for employees related to on-site cafeteria meals or de minimis meals, these are 50% deductible. With the sunset of the TCJA, there will no longer be a deduction for meals in 2026 and going forward. So that's one thing to just consider as you navigate your meals expenses. And then a couple other smaller fringe benefits. So for moving expenses, reimbursements are generally taxable income to the recipient. In 2026, reimbursements are excluded from the recipient's taxable income. And for bicycle commuting reimbursements are generally taxable income to the recipient in 2024 and 2025. And then in 2026, qualified reimbursement may be excluded from employee wages up to $20 a month. So there are some business provisions that are not currently subject to change that we'll walk through. Shad had already mentioned, but the corporate tax rate of 21% remains in effect. Net operating losses are generally limited to 80% of taxable income, and the remainder is carried forward indefinitely without carryback. Under Section 163J, business interest deduction is limited to 30% of adjusted taxable income. Like-kind exchanges are limited to real property, and personal property is ineligible. Specified research and experimental expenditures are required to be capitalized and amortized over 5 years and 15 years for foreign activity. So it's a good time to consider maybe an R&D study to see if there's credits available for that. Shad had mentioned, but the simplified methods of accounting remain available for small business taxpayers with average annual gross receipts less than 25 million adjusted for inflation, and that 2024 figure is 30 million. So if your company has less than this in gross receipts, it's a good time to connect with your current CPA and figure out if there are methods of accounting that would be beneficial. Talked about this, but the enhanced Section 179 expensing remains in effect. The Tax Cuts and Jobs Act repealed the 20% AMT on alternative minimum income. However, the Inflation Reduction Act created the corporate alternative minimum tax, which imposes a 15% minimum tax on adjusted financial statement income of applicable large corporations for taxable years beginning after 2022. Generally, an applicable corporation is a C corporation with average annual financial statement income of more than $1 billion. There is still no deduction for entertainment expenses, and that will remain in effect. And employers are generally not permitted a deduction for transportation fringe benefits provided to employees. Shad will talk about some individual provisions.
All right, so tax rate increases. We did discuss this a couple times, but it's good to reiterate. We are going back up to the highest rate of 39.6. We discussed the opportunities to bring in more income prior to increase in tax rates. Another option is really to take advantage of long-term capital gain rates going forward. One item that comes to mind in food and bev is just exports or foreign sales. You can look at whether setting up an ICDIS makes sense for you. The tax arbitrage, keep in mind, when we had qualified business income, went down from 29.6% to 23.8%, 20% being long-term capital gain rates, 3.8% being net investment tax. Well, when you look at 29.6 and 23.8%, we're talking 5% plus. So we didn't have that big of a tax arbitrage. But if we're going to go up and the qualified business income deduction doesn't get extended by an act of Congress, now we have a tax arbitrage between 39.6% and 23.8%. If we have foreign exports, now's the time to, have that conversation, and maybe setting up an ICDIS makes sense due to that tax arbitrage. Alternative minimum tax is going to come into play in 2026. There are going to be changes to the exemptions. We're going to have changes to the phase outs. We also know that SALT cap is kind of going away, and so there's going to be state and local tax deductions. However, those are going to be added back for AMT purposes. So just something to keep in mind as we plan. We might have the benefit of deductions, but not realize that benefit through tax due to the alternative minimum tax. So again, something to keep in mind. Individual changes, we have the personal exemptions are back. However, with that, we end up with the standard deduction getting cut in half. There's some planning opportunities around this too. I know for some taxpayers, they really weren't worried about itemized deductions due to the 29,000 of standard deduction. However, we'd probably want to reach out and get all the deductions. And one of the items I think about is charitable contributions. Is it such that now that we're going down half to half of that, we could have the potential of having two years worth of charitable deductions and just doing that every other year if that meets the client's needs or taxpayers' needs, and they're good with that with the charities. So there's options for individuals on itemized deductions versus standard deductions. It's just good to talk that through.
And so, good segue into this. The itemized deduction phase out. So prior to the Tax Cuts and Jobs Act, there was a P's limitation where some itemized deductions were reduced by 3% of the amount by which AGI exceeds a threshold amount, with a maximum reduction of 80% of total itemized deductions. These thresholds pre-Tax Cuts and Jobs Acts were $266,700 for single and $320,000 for married filing joint. With the Tax Cuts and Jobs Act sunsetting in 2026, this P's limitation comes back. There are some itemized deductions that are not subject to the limitation, including medical expenses, investment interest, charitable contributions, and casualty and theft losses. There are some changes too with like the charitable contributions. I think the Tax Cuts and Jobs right now is at a 60% limitation to AGI. And when that sunsets, it'll go down to 50% limitation of AGI. And casualty and theft losses are currently limited to a federally declared disaster, and that sunsets at the end of 2025 as well. And we already talked about the state and local tax cap, but there will be no limitation on that when the TCJA sunsets. For estate and gift tax, the current exemption in 2024 is $13.99 million for individuals and 27.98 for married couples. This exemption reverts back to pre-Tax Cuts and Jobs Act levels, so in half, which is a big change, and it's a good time to consider any gifting opportunities before this exemption is reduced significantly. It's a use it or lose it situation, and so if you're someone who is wanting to transfer wealth at any capacity, now is the time to think about it. There are many different ways to transfer wealth and still have access to cash flow. This is something we can help with, or talk with your current CPA or attorneys to see what can be done now to take advantage of the current high exemption.
All right, so I'll just do next steps and planning opportunities. We're kind of running out of time. If you have questions, we'll get back to you on those questions through email. Sorry about that, but let's get just to the next steps and planning. Some of this is going to be redundant, but we thought going over it is just a good idea from a planning standpoint. Anna mentioned the modeling. I think that's a great idea for these expiring provisions to evaluate potential new planning opportunities. You know, look at what the tax will be prior to 2026 and what they will be after the tax law sunsets. You know, what are our options? It's good discussion to go through. You know, let's review counting methods. We talked about that, accelerating, deferring opportunities to take advantage of low rate years versus higher tax rate years. And then it's time to, you know, time the upcoming transactions with expiring provisions. You know, I mentioned, hey, if there's a transaction going forward with non-business income, you know, do we want to have some losses that revert to net operating losses, you know, to help offset that, just as an option. And then, as Anna mentioned in this last slide, reviewing your estate plan to identify opportunities to take advantage of the increased exemption right now is a great idea. If Congress doesn't act, we know the lifetime exemption will be cut in half. You know, you're talking 40% of basically $7 million. You know, we're letting a lot go by there. It's time to plan now. There could be a lot of last minute decisions to get appraisals, valuations, vehicles set up like trusts with attorneys. We really will run out of time if we wait till late next year. So the estate planning can get started now. The vehicles can be set up now. We could kind of plan for the appraisals for next year. If Congress does make a change and they do act, we can always change course, you know, prior to gifting. If Congress doesn't act, we don't want to wait too long and not be able to take advantage of the expiring lifetime exemption. With that said, even without the reduction in the lifetime exemption, it could make sense to gift now. If we are over the limits and we have appreciable assets, it'd be good to have the appreciation out of your estate. You know, gifting appreciable assets is better to have done now so the appreciation can continue to move out of your estate. With that said, I think we're kind of running out of time here. I think we have just a few seconds left, so I'll hand this over to Amy to wrap up the webcast. Thanks, everybody.
Thank you.
All right. Well, thank you. Thank you, Anna and Shad. To our audience, this was a short and sweet webcast. So like Shad mentioned, we don't have time for questions, but you can drop a note in the Q&A window now or reach out to our presenters directly if you have questions. Their contact information is in your console. And then finally, here's a link to a survey for today's presentation. And again, thank you for joining us and take care, everyone.